The Reserve Bank of India announced several schemes to infuse liquidity into the banking system through multiple rounds of long-term repo operations, beside cutting the key lending rate by a cumulative 115 basis points since the start of COVID-19 in March. Overall, the total amount of liquidity infused into the system is estimated in the range of Rs 8 lakh to Rs 9 lakh crore under various schemes. This liquidity infusion has helped to ease up the funding crunch but has largely benefited big companies with top ratings. The smaller ones are largely left out as banks have turned more risk averse. That is, the RBI's rate cut season may not continue for long. In the last monetary policy, the MPC has hinted that it could stay on hold for a long period if inflationary worries persist. The retail inflation rose to 6.93% in July and remains above the upper tolerance band of RBI. The inflation trajectory remains key for the MPC to chart out the policy path ahead. On account of the RBI measures, the large liquidity infusion and rate cut, bond yields have been falling. On 21st August, government bond prices fell to 3-month low with yields on the 10-year benchmark bond hitting 6%. While the coronavirus pandemic has kept the bond prices fluctuating, over the last 1 year the yield curve has steepened drastically. The yield curve simply shows the relationship between different interest rates across different tenures, where the bond prices are inversely related to bond yield. Short-term interest rates on the curve have come down because of massive liquidity infusion by the RBI in the form of targeted longer-term refinancing operations. Conversely, bond prices had been rallying since mid-April. The yields on the 10-year benchmark bond fell to 5.7% in July from around 6.2% in March, which had rallied to a high of around 6.5% in mid-April. So what lies ahead? It all depends on the inflation trend. RBI Governor Shaktikanta Das said it is important to keep our arsenal dry and use it judiciously, as per the MPC minutes, noting that even though there is a headroom for further monetary policy action, the committee will wait for some more time. Given the uncertain inflation outlook, the RBI governor also emphasized the need to remain watchful of the inflation rate. It is fair to expect that the RBI may be on a wait-and-watch mode for now. If interest rates are cut when inflation is rising, cheap money could spike inflation. For 10 straight months, inflation remained above the RBI's medium-term target. It was more than 6.23% in June against the target of 6.09%. But despite the falling interest rates, investors have been considering bank fixed deposits a safe haven during times of economic uncertainties due to COVID-19. Similarly, investors are avoiding equities and other risk assets to buy bonds, which is driving up the prices. RBI's rate cuts and liquidity operations also supported the bond price rally. It means that the cost of borrowing money has risen. Rahul Gupta, Head of Research Currency, MK Global Financial Services, told CNBC TV18 that however the lockdown and supply constraints have given rise to India's inflation data, which is hovering above the higher band of 6%. The increasing inflation has made RBI uncomfortable, and the minutes hinted that the central bank may not cut the repo rate, at least as the inflation trajectory comes into target range. On August 25th, RBI announced OMO of government securities worth Rs 20,000 crore. But higher bond yields are affecting smaller companies more than the bigger ones. Globally, the US 10-year Treasury yields also declined after Federal Reserve decided to hold interest rates steady on July 29th. The Euro 10-year bond yields declined after ECB maintained status quo on its key rates in its policy meeting on 16th July.